Hi, everyone. Welcome to day one of the Synergy Traders number 55 Tech Wizards 2025 conference, where we are going to be discussing algorithms, apps, platforms, and that sort of thing, technology for trading and investing. So this event is brought to you by TradeOutLoud.com and TimingResearch.com, along with our co-sponsors OptionProfessor.com and MadHedgeFundTrader.com. And of course, these presentations are for educational purposes only. Trading is not suitable for all people. And please consult a financial advisor and only trade with money you can afford to lose. All of these sessions are being recorded individually and will be available on TimingResearch.com. And also, if you search for Timing Research on YouTube, Substack, or your favorite podcast app, you can find the recordings there as well. So to open the day for us, I'm happy to have Todd Horwitz of BubbaTrading.com here to be our first presenter.
Great to be here. Thanks, David. I'm always great, and always great to be involved with a good crowd. Anka and the Mad Hedge Fund and others are all great people. So let us begin. And of course, good morning, everybody. Today we're going to be talking about our ratio trade or ratio trader. It's basically a dual direction method of trading, and it's one that has been very successful and one that I've used for going on 45 years now. So again, it's something that I'm always very proud to present and share with everybody. In the meantime, you just heard David go through their disclaimer. We all have the same standard disclaimer, and it's for educational purposes only, blah, blah, blah. Again, you're not getting rich tomorrow, okay? You got to do your job if you're going to trade. You got to understand the risks that go along with it. And if you think you're going to turn 5,000 into 500,000 tomorrow, you have no chance. So please don't go into it with that idea. Go into it with the idea that you're going to learn something and that you can put this to work and make money. But the trading itself is a grind. For those of you who don't know me, I am Todd Bubba Horwitz. I've been doing this for 45 years. I was a floor trader for 30 of those 45 years. And of course, we know there's really no trading floor anymore. I also do a lot of TV and radio. I developed a lot of options and future strategies. I've written a couple of books. And I've spent the last 15 years teaching because, again, I have time because there's no floor to go to. So it gives me time because I'm a retail trader just like everybody else here, okay? Now, again, when we look at the markets, we got to understand the key terms first. And one of the key terms is derivatives versus stocks and versus commodities, okay? Well, if we look at the derivative world, options are derivatives. In the futures world, there's called forwards are derivatives, but there's also the underlying commodity, okay, the underlying future. In the markets, the futures markets, the S&P future would be considered an underlying. Okay, the options on that, whether they be done through the spider, through the SPX, or through the S&P itself, are derivatives of that product. Okay. So what we like to do and what we're going to get to today before it's all said and done is how to use the underlying with the corresponding derivatives, because in my view, there is nothing better, okay? Now, anybody who trades or anybody who's traded for more than a week understands that in this business, we have what is called drawdowns, okay? You go through losing periods, losing days, whatever. It should not be a problem, okay? It should not be an issue. A drawdown, if you understand the method that you're using correctly, a drawdown actually becomes an advantage because it allows you to add to your position sizing, knowing that your favorability or profitability is much higher based on the drawdown that you incur. Net neutral. That is really what the trade that we're dealing with is going to be net neutral, okay? And what does that mean? Well, if you understand delta, okay, then you understand that a underlying security, like a stock, is 100 deltas, okay? So if you trade on a ratio and you can bring the deltas to even, then you are putting on a trade that is net neutral, okay? What is net neutral? Why do you go to net neutral? Well, if you're using it as a ratio, okay, of options to the underlying, then you can benefit from either direction of the market, which is what we're trying to accomplish We want to be able to benefit on a big move in either direction. Okay. That is what this comes down to, is learning how to benefit from any big move in the market. For example, overnight, what happened yesterday, last night, Sunday night into Monday, the S&P, the NASDAQ was down over 1,000. I mean, we cashed in really well on that trade. But again, I'm not here to talk about what happened in the past. I'm here to share with you how you can go about doing this in the future and doing it for yourself and recognizing where those opportunities come from. Okay. Now you can do this manually, or you can do it with our managed trading. We have a way to do this for you through letter of direction trading. Again, we're here to help. I'm here to teach. I want to give you the best opportunity to be able to make money while you're in the business, okay, with also make money with the least amount of risk to go along with it, okay? Now, there's always risk, so we always have to recognize that, okay? What the heck is dual direction trading? It's a trading program where the trade place make money whether the market go up or down. Any of you trade options here? Does anybody trade options? You wouldn't mind typing a yes or a no in the chat room? It'd be interesting to find out. Okay. Well, let's say that if you do trade options, then there's one key risk in the option market, which is time decay. Okay. In the underlying, there is no such time decay. So if you're using a combination of the underlying with the option, your true risk comes to the option premium or the time decay. Okay. It doesn't matter, but this method does require options and the underlying security, or options and the underlying future, because that's how you create that neutral type trade. A lot of times on the floor, when we were trading, we would call it an arbitrage. Okay. We're looking to arb the market and put ourselves in a very favorable position, looking for some movement in either direction of the market. So dual direction, okay. There are some that are dual direction, but not like what we're teaching here. If some of you from out of the country are trading CFDs, you know, you can be long and short, but you really have no edge, because you can't make any money until you take off one side of the trade. So then you're basically just putting on a position. This trade can make money while both positions are still on. Okay. You can make money with a big move up or a big move down. Okay. But what we're looking for on the ratio trade is whichever direction we put the underlying security on, that is the direction that we will make the most amount of money. So if we're short the stock or short the future, okay, and long the options, our biggest gain, our biggest potential profit will come to the downside. Hence, if we're long the futures and long the put in this case, then our biggest gain will come to the upside. Because what we're looking for is for a big movement, and to the side of the derivative, we can assign an absolute amount of risk. We know exactly what the risk is on our option side of the trade. So if we can get a move big enough in the underlying stock or big enough in the underlying future, then we can define and know exactly where we are. So we know that if we have let's say, for example, a $2,500 risk on the option, then if the future makes more than 2,500, we can lock in a profit and own the options for free, giving us a dual chance to make money back on the other side. That is the whole thing when you're looking at using a delta neutral or a slightly biased trade, which is hence neutral to begin with, okay, has only risk to time, but once you get movement, it then pays off in big spades. And you have, again, you get the overnight move like we got the other night. You can see that you can make a ton of money if it goes and if it works your way. If it goes against you, you make money on the other side. Again, you're going to make more money to the direction that you are with the underlying than you will with the options, because if you understand delta, okay, the trade kicks off. If we're using a 5/3 ratio, the trade kicks off at a net plus or a net minus of 50 deltas. So if you're not quite sure what I'm talking about, that equals 50 shares of stock. Okay, so either long 50 shares or short 50 shares, that's pretty neutral. So you know exactly how much money or how much movement you need in the underlying to cover the cost of the options. And once you get by there, then you're all in profit. But of course, the trade can stay, the underlying futures or the underlying options stay at a constant 300 delta, okay? Versus the options can go to a max of 500 delta. So you can go to a max of plus 200, which gives you an opportunity to make money even when you're wrong. Okay, even when it's not going your direction, as long as the move is big enough, you can make money on the other side while you're waiting. And then you can recreate the trade, which we've actually done in the last week. But I'll get to all those things and more. But the benefits of this trade are defined risk. You know exactly what your exposure is the minute you put the trade on. Okay. You've got high potential returns. Okay. Now our target on these trades is typically between $1,500 and $2,500 profit. That's what we're trying to make. But you know, you do get the rare occasion where you get a move bigger than you could ever expect, and it makes a little bit more. But that our goal or our net is to try to make $1,500 to $2,500 per trade. Okay. You have market access. You can take this as long as you have a liquid market, liquid options, you can trade it anywhere you want. Plus the fact that you can cross markets. Okay. For those of you who do trade options, you can trade the SPY options against the S&P because the SPY options are a derivative of the spider, which is a derivative of the S&P future. Okay. So again, you can cross because you're getting the same coverage. All you have to understand is what is the correct ratio that you have to use to put that on, but you can use markets in different markets. So for example, in the futures market, the NASDAQ options are not liquid. Okay, the futures are very liquid, the options are not. Okay, so when we want to do a NASDAQ trade, we use the NASDAQ futures with the QQQ options. It gives us a trade to make. We have the same protection because the ratio is the same. Okay, so we can now lock in a trade with very little risk. Okay, with potential for unlimited profit. But again, we normally target, and we will most of the time be working in order in our underlying to take us out at a $4,000 to $5,000 profit, because we know that typically in our option side, there's somewhere between $1,500 and $2,500 worth of risk. Okay, so if we can surpass that level, okay, with our underlying, we can cash the trade out, okay, and move on and hold the options for free. Does that make sense to everybody? Are you cool with that? Again, I don't want you to get lost when I'm explaining what I'm talking about. So I want to make sure you're following along, because this is an invaluable trade for you going forward. Okay, whether you become a member with me or not, this is an invaluable trade if you can learn it. Okay, this is probably the main trade I used on the trading floor for 30 years. Okay, lost. Okay, that's okay. I get it. All right, I'll help you with that. I'm going to get to that right now. Okay, here. So let me just pull up my Thinkorswim real quick. Okay, so if I go to the SPY options, okay, SPY, okay. So I'm not putting this trade on. I'm going to pretend I'm putting this trade on. So the spiders are trading at 600. Okay, so I'm going to buy the at the money calls. Okay, which is let's say the 601 for Friday. Okay, the 601 for Friday are trading at $4.51, $4.53 now. Okay, so my cost for 5 of those would be about $2,300. Okay, okay, a cost of $2,300. Then if I buy the options, if I buy the calls, I want to sell the ES. Okay, actually I want to sell the MES, which is the micro. Okay, so I'm going to sell the micro at, let's say, 60.58. Okay, so now I've established I've got a $2,200 risk on the option side. My future side is covered up by the options, so I have virtually no risk to the future. Okay, all my risk comes in time to the option. So when any direction I move from that point forward, I can make money on either side of the trade or both sides of the trade. Okay. So that's kind of how it works. It may not help you enough to make you understand yet, but you'll get more as I go more into this. Okay. In the meantime, we're also trading volatility. Okay. So we want to make sure that we have the opportunity to take advantage of volatile markets. And of course, the volatility side will help our options. Okay. The futures don't have implied volatility, but options do. So when volatility rises, it helps the value of our options on top of everything else. Okay. So that's what we're trying to do. And then, of course, it's a very low barrier to entry. Now, here's where it gets a little bit confusing for many. If you're using the equity options against the futures market, your margin is much higher than using futures options against futures, because you do not get what they call cross margin. They don't cover your margin up. So the trade I just showed you to put on, which we would put on 6 micros against 5 options, my actual cost for that trade or margin requirement would be about 9,000. Okay. However, if I put that on futures against futures, my margin requirement would be about 900, because my options would actually cover up my futures. Okay. But you have a very low barrier to entry. Okay. And you have a longer timeline to get profitability. You know, you can hold these trades for a long period of time while they're trading. And again, there's a reason that you make an entry and you look for a trade. And just a quick look at a chart. I'm kind of mixing back and forth here to kind of give you an idea, okay, of where I would be looking for. And right now, I would be looking in the diamonds or the Dow. I would be a seller of the Dow futures now. In fact, when I get done with you guys, I'm going to put this trade on. Okay. I'm going to sell 6 micro YMs. Okay. I'm going to sell 6 micros, and I'm going to buy 5 diamond calls for Friday's expiration, because my cost is lower. And if I get a move, then I'll be able to capitalize and cash out. But the reason that I'm doing this is because, in my opinion, and based on the Bollinger Bands, this market is very overbought. Okay. With yesterday's big sell-off, this did not go down. It kept going up. So the market itself is very overbought. So the probability suggests that this will have a mean reversion, okay, which will make me money, because if I sell the future at 44,994, let's say, and I can buy it back at 43.5, okay, I've now made 1,400 points, which is $7,000 times 60%. So I've made $4,200. Okay. And then, of course, I lost on the option side of the trade. And the option side of that trade right now would be, okay, so if I bought for the 31st, I'd be buying the at the money calls to 448. Okay, and the 448 calls are $3. So I'd be risking 1,500 on one side to make who knows how much. Okay. And again, that would be my overall risk. And if it doesn't work this week, I can carry the trade forward to next week. And that is what we're looking for those opportunities to continue to find the reason. So I have plenty of time. I'm not in a rush to get out of the trade. Certainly, if the profit comes, I'm going to take it, but I don't have to rush, and I don't have to panic, because again, I know exactly what my overall risk or what my overall exposure is once I put the trade up. Okay. Now, the major risk, no movement. There's where the time decay issue comes in. When you get no movement in the market, your options will continue to decay. Now, again, as long as they stay somewhere into the money, they're going to have some value, but that is where the risk of this trade comes in, is when the markets do not move. Okay. Now, again, even in these slow, crappy markets, and I got to tell you, they have been slow and crappy. Okay. Other than a couple of moves, you don't still have a lot of risk. Okay. Because the premium is the risk. And of course, as long as the options, remember, the options themselves have some value. And as long as they don't sit at zero, the futures will move, which means that the futures move in either directions. Your options are going to move a little bit in either direction. Okay. So the odds of you having a straight time decay loss without any movement is very, very remote. Now, it can happen. So I want you to be aware that it can happen, but it is virtually an impossibility. But anything is always possible, as we know. In fact, as As traders, the improbable happens once a week, the impossible happens once a month. Okay. The ratio trade is neutral. So the trades I've showed you so far are both basically net neutral. Okay. The market picks the direction that you're going to go. You're not making it, you have no opinion to the market. The market is giving you the opinion by the way that the markets move. Okay. So if you're long the future and long the puts, if the market goes up, the future makes money. The put options can go to zero. The futures continue to go up. Okay. Or vice versa. You're short the future, the markets go down, the calls go to worthless, the future keeps going down, which is why the most amount of money on these trades is made as long as you're correct on direction. But if you're wrong on direction, you still get to make money and you still have the opportunity to make money. Okay. And that's something that's important to understand. Okay. Now, setting up the trade, okay, you're going to buy or sell the underlying instrument. So if I go back to our example, okay, I'm going to sell the Dow. Okay. I'm going to sell the YM. Okay. That's, I'm going to put this trade, I don't normally do this, but I'm going to do it with you guys right now. I'm going to put this trade on live. Okay. Hold on one second. So I'm going to sell 6. Okay. We're trading for 6. Okay. Hold on. Okay. You'll hear the noise. You won't see the trade, but I'm going to sell 6. Okay. And there it filled. Okay. And now I have to go to a screen up above. Okay. And I'm going to buy, I got to buy in my active account. Okay. So hold on. Let me go to my diamonds. Let me get the trade on. Okay. While we're here, I'm doing this live. Okay. Go to the 31st. Okay. And I want to buy the I'm going to buy the 449s because the market's already rallied a little bit. Okay. I'm going to buy those. Okay. And they're trading at 266. Okay, I'm just going to get them on so I don't have to deal and waste your time waiting for this order to fill. Okay, so now I am now in that trade that I just told you about. Okay, I am short the futures. Okay, at my fill was at 45,019. My fill on the calls was at 266. Okay, so I've got a $1,330 risk on the option. I have no real risk on the future because my options are covering up that futures at a 3-to-5 ratio, short 3, long 5. And the reason somebody's going to say, well, why did you sell 6 of the micros? Because one full micro, one full S&P is 500 deltas. Okay, 6 micros is 50 delta each, which makes 300 deltas. Okay. I bought 5 at the money calls, which is 50 deltas. So I'm net short 50 deltas right now as we're trading. Okay. So I did that for you right now while we're here. Okay. And we'll see what goes on from there. In the meantime, purchase calls or puts depending on the direction of the future. So I shorted the future because I think it's dramatically overbought. I bought the calls to cover up the short future. Okay, an example, short futures, long calls, which is exactly the trade I just made. Okay, now examples of the trade. Okay, here is a trade that was open, and this is from a member. This was posted in my chat room. Okay, this person was short the MES futures at 6,000. They were long the at the money calls 593 for September 24th at $5. Okay, and they cashed out. Okay, on both trades, which you'll see. Okay, they made 3170 on the Q side. Okay, and they made 2170.81 on the MNQ, so 5,200. And on the S&P, they made 3310 and lost 2677, so they made $700 profit on that trade. Okay, so there's a trade that went against us to start with. Okay, which we made money on the wrong side of the trade. And then, of course, yesterday, we got paid off in spades as the market came back down overnight and we had the orders working. Okay, because the good thing about this thing is your futures orders, you can have them working 24 hours a day, 7 days a week. You can put them in good till cancel. Why? Because you don't have to do anything. You don't have to do anything with it because if you cover at a profit, okay, then you're done. Okay, then your calls, then your calls or your puts are free. Okay, then your calls or puts are free. And that's something that you always want to focus on is, again, the whole game of we trading is managing risk. Okay, that's everything we do is about the risk we're taking and the potential profit we can make. It's a risk model, and this is as far as risk is concerned, this is about as low of a risk trade you can make with a potential profit of monster profits. Now, again, we don't go for monster profits because we put in orders at 4,000 or 5,000 profit on the underlying side. But you can make the same trade with the QQQ against the QQQ options. But one of the problems when you're using the equity side of the market for the underlying is the margin cost and the Reg T and all those other things. Whereas futures are a much better deal for margin. Okay, you get a much better break on the margin side of those trades. Okay, when do you get the ratio strategy trading program? 3 ways. Okay, you can manually take the trade and follow the signals. Okay, because I send them out. Okay, you can learn to set the trade up yourself and manually. Again, I'm looking. Again, right now I use only the future side because most people don't have enough capital, okay, in their account. But for example, if you did have enough, well, this one you could probably trade. Let's say an example in an NVIDIA, okay, NVIDIA got clobbered yesterday. I would be a buyer of NVIDIA, okay, of the stock, and I'd be a buyer of the puts on a 5-to-3 ratio as well. It gives me the same information. And of course, it's a lot easier to buy, but now you're tying up, if you do 300 shares, you're tying up $36,000 of margin. And then you got to take into account the cost of margin, right? If you're using the equities, I mean, margin rates now are about 9%. Okay. Now that all plays into it, which is why I prefer using the future side. But if I look at the futures that I'm willing to trade, crude oil, nothing. There's no trade right now. I did have a trade on crude myself. Okay. When I sold crude up in here, covered the crude, now I just own the calls and waiting for hopefully a bounce back. I already made money. It's a cash no matter what. The S&P, we had this one on. We had the NASDAQ on. Okay, you can see they're all done from extremes in the market, either overbought or oversold positions. Okay, and that's what you're looking for. Again, it's not complex. It's just having somebody watching for you can help you set up the right type of trade. Okay, and of course, you can set up the execution done by our letter of direction trading. We've got a team that works through letter of direction. We have a broker that we do business with, Capital Trading Group, okay, that will do the trade for you. I send them the trade. I send them the parameters of the exits and the entries and how we trade it, and they set the trade up for you. Okay, so you don't even have to watch if you don't want to. That becomes entirely up to you. Okay, it's our LOD program. And of course, we also have, if you manually take the trade, you get the information on my Saturday weekly options call. Okay, because I teach options. I teach everything. Okay, I've written 2 books on options, but I teach it all. But what your real recognition is the patience. Okay, the patience to wait for the trade to appear. So again, I'm looking at the Russell, and for those of you who may or may not use the Bollinger Bands, I use them to teach with. But they also do help you recognizing when a market is extremely overbought or when a market is extremely oversold. And you only want to use this trade when the probability is that you're going to get the biggest amount of movement in the direction that you're looking for. Does that make sense to everybody? I know you guys don't like to participate, but it's easier if you help me understand that you understand it so I can help you go forward. Well, I know you make this trade already. Okay. But again, we're looking for extensions, we're looking for opportunities. Even Bitcoin is a player here if you like Bitcoin. Okay. I mean, it works in any market. Okay. Bitcoin would have been a potential trade up here. Right now, I'd wait. Okay, but the bonds and notes, those are potentials right here. They're both very much overbought. So the product itself is not a big deal. Okay, the product itself has no bearing. Okay, what you're looking for is the direction, and is the market overbought or oversold, and is the probability of movement in your favor that it should come back in your direction. That is what you are focusing on, okay? Not the individual issues. I don't care about the news. I never watch the news, okay? I'm telling you that you want to make sure that you put yourself in a position of where is the probability higher, okay? Now, can this continue to go up? Can the bonds and notes continue to go up? Yes, they can, okay? But at the end of the day, they are overbought, and there is a high probability that it will come back. Now, you have an interesting position in this particular trade coming tomorrow. So it may be a trade you might want to look at. And what's coming tomorrow? You got the FOMC coming out tomorrow. Well, since the FOMC is about interest rates, and since the bonds and the note futures are about interest rates, you could get some very big movement. You're already in an overbought position. You could get some very, very big movement. And if you believe that the Fed is going to cut rates, then these should go higher because these go inverse of rates. If you believe that the Fed will not cut and these will fall, okay, and interest rates are going higher, which I personally believe, then this will fall. So, but right now you're in a position, forget about any other story. You're in a position that this trade can be made on this market right now, if you choose to do so. And you don't have to worry about it, because if the markets explode up, your long calls will overcome your short futures and make money. If the market tanks, your short futures will make a fortune. So that's, again, what you're trying to look at, is to position yourself based on a market that is extended in one direction or the other. Gold, getting back closer to that, okay? Silver, nowhere near anything. So again, there's not a trade every day in every market. There are very specific circumstances that we're going to look for when we look at these trades, okay? And I think that's something that you want to understand, okay, is how you're going to go about it. Do you want to do it yourself? Do you want to have somebody do it for you? But at the end of the day, these are great trades to look at. When you do get very extended in any market, you want to take the opposite side, because we're going to assume mean reversion. And just because a market gets overbought, okay, does not mean it's coming down immediately. And for example, in this example in silver, it got overbought here, but it actually continued and was more than 2 or 3 standard deviations away from the mean. Okay, and if you look at the markets as a mathematical model, which is what you should be looking at, okay, it has nothing to do with the news. Okay, you know, everybody was talking about yesterday, well, the markets got creamed because of DeepSeek. Well, I call bullshit. Okay, because at the end of the day, we knew about DeepSeek before Sunday night. It wasn't new. Okay, you think that suddenly it was a surprise to the world that China was going to do something like that? So again, you have to understand and recognize those opportunities. Okay, we also do a Monday night strategy call where we cover a lot of these trades as well. Okay, these are part of the programs that we offer to you to make sure you understand. You get daily signal emails to stay ahead of the market. Okay, every morning, actually, depending on which product, but every day before 5 o'clock in the morning, you get an update telling you where we're going, what we're doing, what we're thinking, and if there are new trades to go. Okay, and we did nothing to, like, for example, today we did nothing. Okay, but we do have open positions already. Okay, we are short the MES and long the calls. Okay, and soon, and I'm obviously, now you saw me put the trade on with you live here. I'm short the YM, and I'm long the calls, and I still have on the calls from, I still have my long calls from the NQ, because I got off on my NQ on Sunday night. Okay, so again, this is a neutral trade that puts you in the best position, and you're always in tune because we have a chat room. Okay, so I always keep everybody updated through my chat room. Okay, and CP can vouch for that, right? Okay, I keep everybody updated through the chat room of trades we're looking at or what we're going to do. And again, if you're not around and you're working, you want to do it, like I said, you have the opportunity to do it letter direction. But again, it goes back, everything always goes back to the market itself and the time frame you're looking at. Okay, so when we're looking at markets, I did a trade yesterday myself as a little experiment. I bought wheat yesterday at 531, okay? And I also bought puts on wheat, okay? But I'm looking for wheat to go up to 560. So again, the product is virtually meaningless. It doesn't really matter as long as you have liquidity on the option side. As long as you can get in and get out and not get stuck on the Roach Motel, you're going to be able to make money if these things move. Now, again, obviously, movement is the key so that you don't get caught up in time decay. But at the end of the day, those options are always going to be worth something. And you'll never take a full loss on the option, because if you take a full loss on the option, that means you made some money on your futures. Okay. So everybody understand that? Just to, again, I just want to make sure you're following me, because again, if you're not following me, then it doesn't do any of us any good. Okay. And then this program includes introductory live classes, advanced market commentary, and gets trade signals. Okay. If you want to join that particular program, it's $200 a month. You can cancel anytime. Okay. Now I have a much better offer for you down the road, but again, if you're just interested in that, that's $200 a month. Okay, and you can cancel anytime. Okay. You can go to www.targettrading.co/webinar. Hold on a second. Sorry, guys, I got a puppy that keeps wanting to go in and out. I got to roll back on my chair. Okay. Then of course, you manually take the trade. We have a small group mentorship where I teach the trade. Covers all the options trades and all the programs, including but not limited to very basic entry-level understanding, weekly call put synthetics, hedging strategies, ratio trades, lifetime access to the program, the entire options trading program, 90 days of access to the pro-grade trading software, skills and confidence to trade on your own after that. And of course, that is usually $44.95. Today, it's $2,500. And the ratio trade executed for you in your account by a pro trader, which is our letter of direction model, unlimited profit potential, limited risk, option premium price, longer term to get profitable, lower barrier to entry, low initial investment, no experience necessary, completely managed for you in this letter of direction product. Okay, and what is letter of direction? It is authorizing a broker, in this case, Capital Trading Group, to execute the trade for you. Okay, and that's all they can do. They can only trade what you give approval for by signing the letter of direction. And each product we do has its own letter of direction. Okay. Based on the predetermined set of guidelines on our system, letter of direction is a powerful tool that enables entry-level traders to get expert-level trades and pro-level traders to get time, effort, and energy and leverage. Again, it helps you get it done so you don't have to. Okay. And there's no additional cost to it. Okay. And if you want to check out Capital Trading Group, it's capitaltradinggroup.com. Check them out. I've been doing business with them for about 12 years. Okay. Use them for all my own futures, as well as bringing my members to them. Okay. How the ratio trade executed for you in your account by a pro trader, early adopters and Founders Club members. Only 3 early adopters licenses left at $1,000 a year. But today, until midnight, it's 500. The coupon code is FF500. Okay. If you want to join today for 500, you can. The code is FF500. It'll say 1,000 on the website. And after these are gone, the next 20 licenses are 1,000, and the next 50 are 2,500. And that's all we're taking. We're not taking anymore, because what we don't want it to happen is we don't want to destroy our own liquidity. Okay. And that's targettrading.co. We're partners on this. They're my partners. It's www.targettrading.co/webinar. Okay. And this would be /ratio/trader or /trader. Okay. Again, it's FF500 for anybody today till midnight. You can certainly check it out. And you want to schedule a call. you want to talk to somebody, you can at www.targettrading.co. You can check out and you can answer all your questions. I got a staff waiting by for you if you want to talk to them. Okay. Again, we've got other automation things that you can use, and we want to make sure, look, our objective is the same as yours. We want to make money. We want you to make money. And we trade all of our own products. Okay. I don't sell these products. I trade these products. You just saw me put on a trade live in front of you. Okay. Are there any questions before I move on? Just in case. Okay, if you have questions, go for it. I have a little bit more for you, but I just want to make sure I don't, again, I always hate if you lose people, they get nervous, they get confused. It's better to make sure we have opportunity to make sure that you're in full understanding. I'd rather explain and make sure you get it than go farther. Okay. Okay. So we have a live signal room. Okay. I trade live every morning with my members for an hour. In fact, I just came from there to here. Okay. We have live online classrooms. We have online trading room. We have trade reviews after the first 100 trades. We have trader checkups. We have a full campus library and lots of extras. Okay. Again, the whole thing for me is to educate and help you. Okay. And any of you who's done business with me will tell you the same thing, that I want to make sure that you are successful, that you have an opportunity to be as fortunate as I have, because I've done well in my 45 years. Okay. It was a lot more fun when I was just trading on the floor, but unfortunately that is no longer available to me. So now I'm out hanging out, retail trade with everybody else. But again, remember what you're looking for. And this goes for anything that you're trading. Stay away from the news. If you trade the news, you lose. Okay. What you're looking for is a probability model. Okay. And if there is no probability, if there is no direction, like the euro currency, there's a couple here that are on here now. I said last night that I would be a seller of the euro currency. It was overbought. And look what happened this morning. It's on about 50 ticks. Now, again, I'm not bragging on how good I am. I'm just saying that you want to make sure that in this business, you are looking purely at probability models. Okay. The overall, again, if you're investing for the long term, then you want to look at the fundamentals. But if you're trading, the fundamentals are ridiculous. Why is it called a ratio? Me is like 1, 2, 3 butterfly. Well, we don't use the third leg. We don't want to cap the side. What we're using is a 5/3 ratio. So it's 300 shares of stock, 5 call options, or 300 shares of stock, 5 put options, depending on which side, or the same in congruence with the future side. Okay. So in straight futures versus futures, the micro ES against the micro ES options, it's 3 futures, 5 options. Okay. That makes it a delta neutral trade, but what it gives you is unlimited profit potential on either side of the trade. Okay. The profits are unlimited. Okay. But the bigger profit will always come in the direction of the underlying. But as I tell everybody, okay, the underlying is the key to control. Why? Because it's got liquidity, because it's got volume, because it's got no premium involved in it. Okay. So for all those reasons, you are putting yourself in a position to make the most amount of money with the least amount of risk. And again, like I said, there is risk. Our biggest risk on this trade, if it's done properly, is just simply the risk of time decay. Okay. But again, when is the last time you saw zero movement in an underlying stock? Okay. For a week. Okay. Zero movement. Because that's the only way you can get wiped out on both. Okay. Is with zero movement. And when's the last time you saw that? I haven't seen it for a while. And I got to tell you something. The conditions overall have been pretty crappy. Okay. So again, but you can look at any market as long as you have liquidity on both sides. So, coffee and orange juice, not so good. Okay. But any stock, but again, I do warn you, when you use the underlying stocks, you are creating, there's a lot more regulations in the stock market, from the SEC regulations to day trading regulations, right? If you don't have an account that's got 25,000 in it, you're a pattern day trader. So you have to make sure, and of course, futures options. I mean, the simplest explanation I can give you. One S&P, one mini S&P, the margin, overnight margin, is about 11 grand. Okay. One mini S&P equals 500 shares of the spiders. Okay. Which is $250,000, which your margin, if you're getting 50% margin, is 125,000. So which is a better trade? Okay. Do you want to have 11,000 margin, or do you want to have 125,000 margin for the exact same position? Okay. And does anybody know the other benefit of using the future side more? Okay. Does anybody know the other big benefit of the future side? Well, if you trade the SPX, you know it's taxed at a better rate. It's taxed as 1256 income, which is 60/40 versus what equities are, which are, it'll save you tax money as well. Okay. So not only can you make money, but it will save you on the amount of taxes that you will have to pay. Okay. But again, you're purely, you can look through all of your stocks, whatever, you can look through all of your futures, however you want to do it. But you can find where there is opportunity. And again, it's very simple. Where's the market oversold? Where's the market overbought? And that you want to then execute a potential trade right from there. And as I look right now, so my futures right now, here, I gave you a live update. My futures right now are down $220. Okay. And my options, hold on. My options are, up $210. So with the trade going against me at the moment, I'm still virtually about even a small loser at this particular moment. Okay. And that's, again, the position that I like to always be in, is to have the least amount of exposure with the biggest amount of potential gain. Okay. And that is where the school that I came from. Okay. Because remember, I was a floor trader. So again, any questions from anybody? Again, if you want to become a member, it's www.targettrading.co/webinar. Okay. And all the things are listed up there. The ratio trader is at a discount today of 500. You use the coupon code FF500. And I do have time for any questions that you may have, and I will continue to show you some potential opportunities or things that I'll be looking at as the day wears on. Apple, no, but we did buy Apple. Okay, this was on a different type of trade, but we did buy Apple down here. Okay, that's part of my Monday night call. Okay, again, you can look for anywhere you want for the potential opportunities that are there, but make sure any trade that you make, you are putting yourself in a position of high probability and the lowest amount of risk. Okay. Again, this is a model itself. Trading itself is a game no different than gin, bridge, backgammon, or poker. If you play any of those games and you're good at them, then you should be a good trader. Because again, they're all probability models to begin with. Okay. Please share with us your link for your information and discounts on your services. The link is www.targettrading.co/webinar. I think David typed it in up a little bit further, but I can put it in, I can copy and paste it, I think, and put it in again. Copy and paste. That should work. There you go. And if you have any questions, you can reach out to me at Bubba@BubbaTrading.com or Bubba@TargetTrading. Either one. I'll be happy to answer any of your questions. Okay. And one more thing I'm going to offer this morning. Okay. For any of you who trade futures, if you become a member today, you can come and trade for free with me for a month every morning. Okay. I trade every morning from 9 to 10 Eastern time. And tomorrow I'm doing a double header. I'm trading 9 to 10 Eastern time, and I'm going to trade the Fed at 2 o'clock Eastern. Okay, with my members. I call trades, I make trades, because I don't, if I ain't getting in it, I'm not putting you in it. Okay. If I'm not willing to make the trade, I don't want you in the trade either. I'm a big believer in doing what if I'm not willing to do it, why would I want you to do it? Okay. So again, there's the web address. If you have any questions, feel free to ask me right now. I got time. I got about 6 or 7 minutes left to go before they want me to get the hell out of here. Okay. So while I'm waiting, in case some questions come in, we'll go back and and take a peek. Well, actually, I'll give you an idea what I do on a daily basis here. This is my live trading based on 4-minute charts. Okay. We use a 4-minute chart to signal a trade. Okay. And in fact, we made this trade this morning, we sold crude. Okay, right there. Okay. We didn't make as much as we should have, but we made some money on it. But we did sell crude because at that time, that was the big volume spike straight up. Okay. And then I went to use a 1 minute to confirm the trade. Again, we use 2 time frames, one to find the trade and one to confirm that the trade is actually what we want to make for the next 3 or 4 minutes. Okay. And I'm watching these 8 markets. So anybody who decides to become a member today, you can come with me for 30 days for free as my guest. Okay. Platinum is not liquid enough. I love platinum. I'm buried in real physical platinum. I happen to like it a lot, but I don't understand why it doesn't trade. But it's not liquid enough to day trade with a group. Okay. Again, I have to make sure if I'm trading with my group, I got to have enough liquidity. Okay. We used to trade platinum in our model portfolios, but it wasn't liquid enough. So I have to be very careful. Yes, I like platinum. Okay. I don't know if I like it here right at the moment. I will tell you right now, though, since you asked. Platinum, I have no opinion right now. I'd love to buy it at 940, though. I do have a working order at 940 to buy it. Okay. But again, I would think that, but again, for everybody, like I said, if there's a bigger group, it's not liquid enough. Okay. So I tell everybody what my opinion is of what I would do, and I would buy it, but I can't give it out as a group because then we destroy the market, right? If you take away your own liquidity, you're really just putting yourself in a jam. Does that make sense? Thank you, and thanks everybody. I'm done a couple minutes early, David. Sorry, but no questions, no mas.